Good evening, everyone. Many thanks for joining us and welcome to our webinar, Maximising the Sale Value of Your Pharmacy in London and the South East. Just to briefly explain how this evening will run, you will hear presentations from Hammad, Naveed and Nikesh Shah of Solicitors, Atif of Hutchings Accountants, and myself, Paul Steet, representing Hutchings Consultants. Thank you, as I say, for joining us. You have to please accept my apologies. I think most of the panel this evening are struggling with one of these sort of seasonal bugs hanging around. So apologies if I do have to break to have a glass of water, but as I say, we'll get through this. So as I say, selling a pharmacy business can be potentially quite complex. So each of our presentations are decided to provide you with an overview of the key elements of a sale transaction which you should be aware of, and also consider should you decide to sell in the future. Our aim this evening is, time allowing, to have a brief Q&A session towards the end. So if you have any questions arising from today's budget or pharmacy sale related queries, we may assist you with. Please send your question confidentially via the Q&A tab at the bottom of the screen, and this will go directly to the team. We'll also run a couple of polls as well to get some feedback from you, which would be great if you feel able to take part in. The webinar is also being recorded and will be added to our website following the event, so you will be able to revisit it should you feel the need to do so. So, moving forwards. So in respect of Hutchings Consultants, if you're not already aware, we are the largest independent pharmacy-only agent in the UK, having operated in the sector for 20 years now. Our well-established team of 9 directors and consultants have accrued between us over 130 years' experience selling pharmacies of all shapes and sizes across England, Scotland, Wales. I've been with the company over 10 years and have responsibility for the company's seminars, webinars, reports and market updates, as well as handling my own portfolio of sales. I'm also proud to report this is the 20th year we've been approved and recommended by the MPA. I believe we are the longest standing recommendation partner. Within the team, we consider this as a real testament to the service we provide to our clients. Finally, we work very closely on a day-to-day basis with both Hutchings Accountants, who also specialise in pharmacy, and Bond. This strong relationship allows us to lean on their expertise if we have an issue during a sale, and has helped save many a deal over the years, which otherwise may have foundered. As a quick overview of my presentation, I will cover the current market, including which types of buyers are most active, goodwill values and valuations, sale timescales, briefly focus on profitability and how important that is to your value, touch on the preparations you can make now in readiness for a future sale, and briefly explain the 6 steps involved in taking a business to the market and finding a buyer. Each of these topics could easily command a full webinar of their own, but as time is limited this evening, I'll focus solely on the key points. So let's start by taking a look at the current market. Generally, the sales market this year has seen increased activity compared to 2024, with London and the South East leading the way. Hutchings has experienced a 91% increase in selling instructions overall, largely driven by corporates and groups continuing to divest branches as part of ongoing reviews of business strategy. In contrast to previous years, independent sellers have been less active, accounting for around 30% of new instructions. On the flip side, pharmacy sales have also increased in London, up by nearly 29% year on year. New buyer registrations have been broadly consistent with previous years, mainly dominated by eager first-time buyers who've accounted for 76% of registrations so far, with the next largest group being independent contractors at 11.8%. As a result of the choice available, buyers are generally taking longer in their buying decisions, owing to a desire to explore the market fully. But once they've decided on a target business, they'll look to move forwards quickly. Overall, despite well-publicised financial pressures within the sector, buyers' confidence remains positive, largely buoyed by the government's long-term vision for the sector, introduction of new revenue streams around services, and lower borrowing costs, alleviating concerns to some degree. So you may be asking yourself, who is actually buying currently? If we look first at sales that have completed in London so far this year, acquisition activity has been evenly split between first-time buyers and independent contractors seeking to expand or add further branches strategically. If we look at completed sales in the wider southeast, outside of the M25, activity has been more varied, often with independents, first-time buyers, and group owners competing against each other. Group owners acquiring strategically have so far led the way with first-time buyers close behind, although their activity has increased by around 20% compared to 2024. There's been a notable trend in first-time buyers seeking to partner up with a more experienced group owner or independent, which has helped them gain better business knowledge, but also given them extra financial strength. So this has helped also overcome potential issues around obtaining bank funding. So let's look at goodwill values and goodwill valuations next, and see how values are performing currently. So we could allocate the whole of this presentation to this subject alone, but as mentioned a little earlier, I wish to focus on some of the key points only. So when undertaking a valuation, there are many factors an agent needs to consider, including profitability. The factors having greatest impact currently on this include increased staffing costs following statutory increases and the various pressures associated with inflation, such as the cost of utilities, fuel, and other cost of living expenses. One factor which has a heavy influence on profits, goodwill valuations, and values achieved, though, is the gross profit margin the business is trading at. I'll cover this again in a short while. So which factors are affecting goodwill valuations? Sorry, goodwill values. As already mentioned, the uplift in volume of pharmacies entering the market over the last few years has created more choice for buyers. This ultimately has led to some downward pressure on goodwill prices achieved across the board, as interest from buyers for each opportunity has been diluted. Although there have been some teething troubles around the introduction of the Pharmacy First scheme in England, it's provided a welcome boost to the market early this year, injecting some confidence, I feel, to potential buyers as a further revenue stream to capitalise on. Although it will take some time to fully feed through as income in the accounts before it can really start to influence goodwill values to a significant degree, I'd say. Business profitability has grown in increasing importance as profits have come under pressure. Many buyers, conscious of their ability to service bank debt, have adopted a more cautious approach and are generally carrying out greater due diligence before making an offer. One of the greatest impactors on value, though, has been the steep rise in buyers' borrowing costs as the UK government and Bank of England have sought to fight rising inflation in recent years. This Bank of England graph illustrates how low the base rate of interest was until around the beginning of 2022, when it started to escalate rapidly. The knock-on effect and uncertainty caused by the rate increases has meant pharmacy buyers have faced increased loan costs at a time when pharmacy profitability has been challenging. The reduction in the base rate over the course of the last 12 months to the current rate of 4% from a high of 5.25 has definitely eased concerns, though, allowing greater flexibility for buyers to make an offer. Hopefully, the rate will continue to reduce further as we move into 2026. However, the current micro and macroeconomic climate suggests it may be some time yet before we see rates falling substantially. If we take a look at the average pence in pound achieved for independent sales, both in London and the South East, they compare favourably to average values achieved elsewhere in England, but we have seen a slight reduction again this year compared to the previous 2 years. A combination of factors, including pharmacy funding pressures, corporate disposals, bank funding, and inflationary pressures, to name but a few, have had an impact. But it's important to point out that the figures you see here are mean average figures. And as each pharmacy business is unique, prices achieved will also vary, with some selling below that average and some above. Sale prices achieved in London year to date have ranged from between 77p in the pound at the lower end up to £1 in the pound at the upper. In the wider southeast, we've seen prices range between 59p in the pound up to £1.05. So this shows there's a no sort of one size fits all when it comes to valuing a business. I can't emphasize enough how important it is that you speak to us if you are considering a sale in order that we can properly evaluate your business to ensure you're achieving the best price the market is prepared to pay. So next we'll take a look at the current sale timescales. So with all the activity in the market over recent years, have sale timescales changed? Is it taking longer for a deal to complete? There are many different factors which can potentially impact the time to reach successful completion. Breaking this down, we'll briefly look at the three main ones, which are bank lending, the sale structure, and finally the NHS change of ownership process. So commonly, many potential sellers ask us if the banks are still lending to pharmacy. So the short answer to this question is yes, they are. Over 95% of pharmacy deals we transact are bank funded, as most buyers, even if they have the cash available, prefer to rely on a bank. So their support is crucial to ensure the market keeps moving. In recent years, lending policies have certainly tightened, and the banks have generally become more cautious in their approach to pharmacy. However, they certainly still consider it a green light sector for lending, particularly buoyed by the government's emphasis on promoting direct access to pharmacies as the first port of call for patients, alongside an increase in income opportunities from enhanced service delivery. Competition between lenders has also intensified, with new entrants to the market helping to drive down the overall cost of borrowing and reducing cash contribution requirements for acquisitions. In many cases, buyers now only need to contribute around 20% towards goodwill, with banks willing to lend up to 80%. When a pharmacy premises freehold is acquired, some lenders are willing to lend a 100% loan to value on that element of the deal. So loans are beginning to prove to be a little bit more affordable for buyers, which is good to see. So traditionally, around 50% of sales at Hutchings have transacted as limited company share sales. But due to the high number of corporate and group disposals, this figure has fallen below 30%, as most deals have completed as asset sales in recent years. Although usually more legally straightforward, asset sales require the buyer to submit a change of ownership application to PCSE, and sometimes, where necessary, a fitness to practice application as well. Average timescales from submission to approval range anywhere between 6 to 9 months still, which is broadly in line with last year. An important change to regulations in October 2024 removed the need for applicants to provide a reference from 2 nominated referees for a fitness to practice application. This has started to speed up approval timescales, but they still remain long and can vary from ICB to ICB. Limited company share sales can potentially be more complicated, but usually avoid the need to apply to the NHS for fitness to practice and change of ownership, which can save some time in the long run. Average timescales that we've experienced for a share sale to complete range somewhere between 4 and 6 months. So as these applications often take many months to be approved, potentially affecting the sales ability to complete, we usually recommend to clients that they're submitted early on at the start of the sale in order that they can be processed in the background whilst the legal and financial components of the deal moving forwards. Overall, it's still unclear how the ICBs will perform in processing change of ownership and FTP applications. With their current heavy workloads and the upcoming changes to their roles by April 2026, the impact on timescales remains uncertain. That said, I prefer to stay optimistic and hope we'll see an improvement. So if you're not ready to sell just yet, we strongly advise you to focus on maintaining and improving your business profitability. This will make your business more attractive to buyers in the market, give confidence to bank lenders, and will also help you maximize your goodwill sale price. A well-known business quote, which in my view reflects the current market well is the one you see here. Turnover is vanity, profit is sanity, cash is reality. Whilst a high turnover business can initially be attractive to buyers in the marketplace, low profits can potentially curtail early interest and adversely affect the goodwill value achieved. The sales market has changed significantly in the last 3 to 4 years, and both buyers and banks have a laser-like focus on the profitability of the target business. The ability of a business to turn a healthy profit could heavily influence both the valuation and its saleability. I'm not here to tell you how to run your business, but can simply feedback on what we see during our work and the conversations we have with many successful owners. We'll take a quick look at the 3 key areas which can hugely influence profits. So business costs, gross profit margin, and services. So for most businesses we review, the greatest expense on their P&L is their staff costs. Wage inflation, statutory wage increases and locum costs, together with a need to provide a greater services provision, have definitely taken a toll and now account for between an average of 17 and 20% of turnover once you include pharmacist costs. So this has risen markedly from the average of 12 to 15% that we used to see in previous years. The budget announcement of 50p per hour increase to the national living wage and 85p increase to the national minimum wage will certainly add some further pressure and could potentially impact some values. A swift calculation I've made indicates that a member of staff on national living wage, which many pharmacy staff members are on, working 40 hours per week, will earn an extra £1,040 per annum, the cost of which will obviously have an impact on the bottom line profit. As you'll all be acutely aware, other business costs have also increased, and we strongly recommend you regularly review your cost base in order to mitigate the impact on your bottom line profit at the end of the year as much as possible. If you think of it this way, for every £1 you can add onto your profit, you potentially add £7 onto your goodwill value by the time a typical valuation multiplier is applied. However, the opposite can be said for each pound coming off, of course. So a healthy gross profit margin can really help you improve your profitability. Having assessed our completed independent sales for 2025, contractors in London and the South East benefit from the highest average margins in England. The current mean average profit margin in London is around 35.9% and 31.9% elsewhere in the South East. However, it's evident margins remain under significant pressure in many businesses. An increase or decrease in margin can potentially have a drastic impact on profitability. We're aware, of course, of the challenges owners face around the supply and cost of drugs as well, and in addition to the remuneration issues that are currently present. But our strong advice to all potential sellers, though, is to maintain or develop a sharp focus on your buying operation to offset as much as possible the prospect of any potential fall in margin. A drop in margin can come as a surprise to many contractors as to the degree it can affect their goodwill value. To demonstrate this briefly, take a look at this example of 2 profit and loss accounts. The turnover and expenses are exactly the same on both, but the left-hand account has a 32% margin, highlighted in yellow here, whilst the right-hand account has a 27% margin. The different margins have resulted in 2 different gross profit figures. If we follow this down to the bottom line, you will see that once expenses of just over £326,000 on both have been deducted from the gross profit, the left-hand account has a higher adjusted EBITDA or net profit outcome compared to the right hand. Once we apply, say, a typical 7 times multiplier to that EBITDA figure, you can see there's a real stark difference in theoretical value there. That 5% difference in margin has potentially affected the sale price by approximately £500,000, which I'm sure you agree is a significant sum. This is a very simplified version of the valuation we undertake, but it's important to highlight that Hutchins don't just rely on this method of valuation alone and will sometimes incorporate pence in pound valuations as and when it's thought appropriate to do so. The next area of increasing importance to both sellers and buyers alike is the service potential of a target opportunity. First-time buyers are aware more than ever that they need to look at services to supplement their dispensing income and are focused on this key area when contemplating submitting an offer. Other buyers, such as group owners, are even more acutely focused on this, having embraced and developed services within their existing operation. Generally, a sole or heavy reliance on dispensing income alone now appears to present a potential risk for many contractors, and the introduction of services as another revenue stream has increasingly become a priority for many owners. A very experienced Northwest England group owner commented to us, or to one of my colleagues, the following. So minimum wage increases and the shortage of trained staff has increased our costs significantly in the last few years. Business is tough, but most of our branches are in areas where the volume of items and footfall is quite high. And with our recent acquisitions, the potential is also very good. We focus heavily on services which help us plug the gap in the reduction in profit from dispensing activity. Another contractor with a group of 3 branches in London also commented to me that in his mind, he now views his dispensing income as paying the bills, i.e. his operational costs, and his services income is his pay. Right, so before we move on, I'm just going to run the first of the polls for this evening. So if you, it's a confidential poll, so please, if you'd like to, please feel free to respond. And let's just get that running. We'll allow about 30 seconds just to complete it. And if there's some time at the end of the evening, I'll be able to give some brief feedback. Let's just run that now. It should be coming up on your screen. Yeah. Sorry, Michelle, is that running at the moment? Is that? There we go. That's great. Lovely. We'll finish up there and move on. But thank you for partaking in that. Let me just use that. There we go. Okay, right. So we'll now move on to preparing to sell. So some of you may be considering, let's say, coming to the market in the near future, and beginning to think about sort of how best to prepare for that sale. So I know there are many demands on your time, but allocating just a little of that time to sale planning and preparation will ultimately make the process smoother and far less stressful for you. Apologies to my fellow presenters if I overlap with them here, but I'll briefly touch on the most common issues we see arise during sale transactions. First, as mentioned, your buyers will want to do due diligence, but so will their accountant and solicitor. They'll want to conduct their legal and financial due diligence. If you haven't sold before or not in recent years, the volume of information requested at the early stages may feel quite daunting. When you are ready to sell, both Carter Bond and Hutchings can provide a checklist of the typical information required by the buyer solicitor. I strongly recommend organising and compiling this during the marketing phase rather than waiting until a buyer is found. Excuse me. That way you can pull together the information at your own speed and under less time pressure. A frequent issue we encounter are FP34 statements in the incorrect trading name. Sometimes this can be fixed quickly through a simple admin change, but in other cases, the seller may need to submit a change of ownership application and potentially a fitness to practice application as well. Um, that certainly happened in the past that I've sort of seen. And as we sort of mentioned, due to the length of time it takes to process the applications, it potentially could delay a sale. So I strongly recommend just checking the name at the top of your FP34s just to ensure the business name on it is correct. Next is sales structure. Hammad, Nikesh, and Atif will go into greater detail shortly around this, but you'll need to determine whether your pharmacy is sold as an asset sale or a limited company share sale. Depending on how you trade, you may not have a choice, but we always recommend speaking to your accountant early to determine which route is appropriate and most tax efficient for you. From a marketing perspective, buyers make little distinction between the two when submitting offers, as both structures are common. Leasehold issues. These can certainly significantly delay a sale. They can negatively impact your value, or in worst case scenario, they can derail a deal entirely. Typical concerns around leases include short leases, which may be anything up to, anything under 10 to 15 years, and leases that have expired, for example. So if you feel your lease may potentially cause problems, I strongly encourage you to speak to us or an experienced pharmacy solicitor such as Carter Bond, who can advise and assist. And then finally, as you approach a sale, it's essential to build your team. So running your pharmacy while navigating the transaction can be extremely demanding. So having the right support around you is crucial. Hutchings and Carter Bond have the experience, the expertise, and specialist knowledge needed to guide you through what can be for many owners a daunting process. We're here to support you and help maximise the return on your years of hard work. So I will now move through to the next stage, which is the 6 steps of selling a pharmacy. So this is just taking you through the process that we run through and giving you a brief explanation of each of those sort of steps. So step 1 is the specialist valuation. Step 2 is the confidential meeting. Step 3 is the preparation of sales literature. Step 4 is identifying quality buyers. Step 5, competitive offers. And step 6, the legals. So if we take the first step, specialist valuation. So before marketing can begin, we need to establish a value for your business and recommend a suitable marketing price. For the valuation, we request your latest accounts, recent FP34s, staff information, and recent OTC income figures. We review the information provided and prepare an adjusted profit and loss statement, similar to what you saw earlier, to establish an EBITDA figure. We then apply an appropriate multiplier and consider other value affecting factors such as location and likely buying demand. Step 2 is the confidential meeting. This gives your consultant the opportunity to understand your objectives and address any concerns you may have. The meeting usually takes place at the pharmacy once staff have left. Alternatively, we can carry out a mystery shop and then meet you off-site at a convenient location. During this meeting, we agree the marketing strategy and answer any further questions that you may have. Step 3 is the preparation of the sales memorandum. So our brochure is designed to present the business clearly and attractively, focusing on profitability and potential. The marketing will only begin once you have reviewed, approved, and signed off the final document. We also prepare a financials pack, which includes copies of the accounts, recent FP34s, VAT returns, OTC figures, and if applicable, a copy of the lease. Step 4, moved on to identify quality buyers. So when identifying buyers, we can use either a full open market approach or a more discreet off-market strategy. The most common is full marketing. We begin by creating a shortlist from our database of several thousand buyers, ranging from first-time buyers to the national multiples. Buyers receive the sales memorandum initially, and those who show interest then receive the financials pack. We follow up proactively to encourage viewings as well. And the marketing is kept under constant review, and the buyer pool can be expanded quickly if needed. Where suitable, we may recommend a targeted off-market approach. With this method, we contact a small number of selected buyers who we believe may have a strong interest in acquiring a business. If an agreement cannot be reached, we can easily revert back to a confidential open market campaign as well if necessary. This particular strategy isn't always appropriate for every sale, but it's certainly part of our consideration when we're assessing the business and giving recommendations to your client. Step 5 is competitive offers. Depending on the circumstances, we may advise considering offers as they arise during the marketing, or where appropriate, we will set an offer deadline basically. So this will always be agreed with you beforehand. To avoid misunderstandings, we use an offer template letter to capture the offer and any conditions clearly. This is particularly important for company share sales, which are generally more complex than asset sales. During the negotiations, we request proof of funding, and we also aim to secure a deposit, usually around £20,000 once an offer is accepted. Where a deadline has been set, we often run a best and final round of bidding, giving buyer parties the opportunity to refine their offers, thereby increasing the competition. And it's this competition that helps us secure the best possible price and terms for you. Once the price is agreed, the sale then passes into the hands of the solicitors. I won't cover this in too much detail now, as Hammad and Nikesh will run through this, and as well as Atif will touch on this as well. But as your consultant, we'd arrange for the buyer's deposit to be transferred via the appointed solicitors into your solicitor's client account, where it's held for the duration of the sale. Hutchings then issue the heads of terms to all parties, confirming the agreement. And our role then shifts from one of marketing to sales progression as we liaise with all parties to keep the transaction moving forwards. So that concludes my presentation. If you have any questions after this evening or would like to discuss a potential sale confidentially, please do get in touch. Whether you're considering selling now, next year, or several years from now, I'd encourage you to contact us early. We can review your business and work together to maximise your goodwill value and ensure your sale is as smooth as possible. Very often, as part of these valuations and business reviews, we highlight areas which may need to be addressed ahead of time. So again, the earlier that we can have those discussions, the more time you have to possibly work through find a solution for anything that sort of comes up. So and we work with you on that as well. In terms of next steps, we can offer you that free verbal valuation. We can also offer you a free tax review of your position. And we can also arrange a confidential meeting with either myself or one of our consultants at your pharmacy or off-site, as I just mentioned. So thank you for your time. I'll now hand you over to Hammad and Nikesh of Carter Bond Solicitors.
Hi everyone. Thanks. Thank you, Paul. That was really good. Oh, can you see my screen okay?
Yeah.
Yeah, good to go. Good. All right. So just to introduce ourselves, we'll get into the firm, but generally this presentation to support Hutchings consultants and Hutchings accountants is to go through the legal process and common pitfalls issues that come about when selling the pharmacy. So just to introduce myself, my name is Hammad Naveed. I'm a partner in the corporate commercial department. I've been doing this for more than 10 years now, and probably safe to say that about 80 to 90% of my day-to-day involves pharmacy sales and purchases. So it's very much what we do day in, day out. I introduced my partner, Nikesh.
Yeah. Hi, everyone, and thank you, Paul. Again, that was a very useful presentation. My name's Nikesh Shah. I'm a partner in the corporate commercial department at Carter Bond, and I also sit in the as a partner in the commercial property department. I've got an excess of 15 years experience in pharmacy sector, whether it be a asset sale, asset acquisition, or a share sale or acquisition. I also deal with aspects of company law, commercial contracts, and commercial property.
So just to tell you guys a little bit about the firm, Carter Bond has been, we're primarily a corporate commercial firm with a healthcare expertise. We've been ranked now for the last 4 or 5 years in both Legal 500 and Chambers and Partners for our healthcare public sector work, for corporate commercial, and for our real estate work. So it demonstrates obviously our experience and success in the sector. And we do probably 60, it says 60 pharmacies per year, but I think that that's probably an understatement, quite conservative. But yeah, we do a whole lot of transactions. In terms of areas, aside from the pharmacy side, we've got insolvency expertise in case there is some financial distress in terms of the sale. We've got employment expertise in case there's staffing issues that need to be dealt with. We've got commercial property expertise in case our selling clients need to extend the lease beforehand or regularize, for example, if it's in the wrong company. And just a bit of a disclaimer before we go straight into it. Obviously, everything we're talking about is hopefully very useful information for you and helps to prepare for the sale, but it isn't quite legal advice. You should see it as general information right now. And please do feel free to contact me and Nikesh because we can then tailor this to your specific circumstances. And over to Nikesh now, who's going to go into the different ways to structure the sale.
Okay. When you first have the thought about selling your pharmacy, your first point of contact will probably be your accountant to decide whether it's going to be an asset sale or a share sale. And depending on which avenue you go down, will have certain tax advantages. So, but just to give you sort of an overview of non-financial advantages and disadvantages of that, an asset sale is where a seller disposes of assets. It can choose which assets that they are selling to the buyer. For example, the most important asset that the buyer will want is the NHS pharmacy contract. They'll obviously want the goodwill, the fixtures and fittings, and certain aspects of the property, whether it be a lease or a freehold. The seller can retain certain of the assets of the pharmacy, the cash in the bank, any insurance claims, any personal effects. So that is a position where the seller can actually decide what he decides to sell to the buyer. One aspect of the asset sale is that the seller still retains the liability of everything that's happened prior to completion. So the buyer will say, well, from completion, I acquired the asset, I acquired the lease, I acquired all these other aspects of the transaction, and the liability doesn't usually transfer over unless in certain circumstances, for example, in relation to the employees and in terms of the property. So there is a distinction about who retains the liability in an asset sale. One other advantage of an asset sale is that the stock value is usually paid much quicker as opposed to a share sale. Stock values are usually done on the morning of completion of the transaction, and normal timescales are usually 5 days from completion, but they can go up to 30 days depending on to assist on the buyer's cash flow. One of the biggest advantages of an asset sale as opposed to a share sale is the due diligence exercise. The buyer is doing due diligence on primarily the business, the employees, and the property. It is not doing due diligence on the seller's company. It's got no real issue apart from just making sure that it's got the ability to dispose of the assets. So that's where limited due diligence is required. And most of the due diligence on an asset sale can be generally done by the solicitors, whereas on a share sale, a transactional accountant will be well versed and well involved in the transaction because they'll be scrutinizing and going through the seller's accounts or the profit margins and be involved in the negotiation of the tax covenants and the tax indemnities. So that's one of the biggest differences, and one of the advantages of an asset sale is the due diligence. Um, Also, there's less risk of the buyer's future operations being affected of how the business was run prior to the sale. So there's less likely to be disputes because the buyer is just buying certain assets. It's not taking over the history of the company and everything that's traded as would be common in a share sale. The main advantages of a share sale, and the biggest probably advantage, is there's no change of ownership application, which from Paul's slide can take a number of months, where the buyer will have to make an application to the NHS and possibly fitness to practice, which can severely delay the application. And it's part and parcel of the transaction process, because obviously the buyer needs to get the consent of the regulator to acquire the pharmacy and have the NHS contract transferred across. Um, One other advantage of a share sale is the 2P process, whereas on pretty much every single asset sale transaction where employees are employed by the seller, there'll be a process, there'll be a consultation that needs to take place. With a share sale, the employer is not changing. It's just the ownership of the company that employs the employees that will be changing. So there usually is not a 2P process that needs to be followed through. Another significant advantage of a share sale is that you generally won't need to get the consent from the landlord to assign the lease to the buyer. Because the lease is already in the name of the company and the buyer is buying the shares in the company. So from the landlord's point of view, nothing is changing apart from the ownership of the company that is its tenants. Landlord's consent can take a lengthy period of time, depending on they could usually ask for references, they might ask for security deposits, and all other aspects to give themselves comfort. This may be negated by the fact if the buyer needs a lease extension, for example, if the term of the lease, even in the company's name, is less than 15 years, you still may need to approach the landlord to get the consent to extend the lease, and also maybe getting consent to charge depending on the terms of the lease. Now, talking about the disadvantages of which goes hand in hand, uh, they've got the change of ownership application, which can obviously delay on an asset sale. The 2P process, the consultation against delays, landlord's consent, which I just touched upon, and the seller has to deal with the remaining assets if it didn't wish to dispose, if it didn't wish to, or if the buyer didn't wish to acquire all those assets, they will remain with the seller. On a share sale, the stock payment could take a number of months, because that's usually as part of the completion account mechanism, which usually takes about 4 months to be finalized and agreed by the parties. And as I touched upon just previously, there's extensive due diligence done on a share sale. You will have to do the due diligence on the business, the employees, and the property, similar on an asset, but now you've involved the transactional accountant on doing all the due diligence on the company, on the financial aspects, the tax that's paid, and that will obviously incur further costs and could actually delay the process. Over to Hammad now.
Thanks, Dick. So Nikesh has explained the structuring side of things. So sometimes one other way to see it is whether it's going to be a clean break or whether there's going to be more activity in the company. So sometimes with an asset sale, if the company owns multiple pharmacies, then it might make sense to sell them as an asset sale. And then when there's one pharmacy left in the company, then that's the share sale, because then the company can just go with the pharmacy. Otherwise, if there's only one pharmacy per company that's owned, then it would be sensible to just sell the pharmacy as a share sale to have that clean break. Once the structure is finalized, which has to happen at the start of the transaction between accountants and lawyers, it then is necessary to discuss and consider whether change of ownership application is required or what type. So if it is a share sale, then this really is the buyer's process, but at the same time, the seller needs to know how it works and how it impacts timescales. So with a share sale, there is no change of ownership application that's actually required, because the NHS contract actually stays with the company that the buyer is going to purchase. So really all that happens in a share sale is that once the transaction has actually completed, then the buyer would submit a form and the seller would actually have to sign that form to say that the superintendent has changed, that there's been a change of director, and that form, there's a specific form to be sent to the NHS, another one to be sent to the GPHC, and they need to be done within about 4 weeks from completion, to avoid their falling into breach with the NHS or GPHC. But essentially, it's a notification to be done after completion. With an asset sale, the buyer would have to make a change of ownership application. If it's a first-time buyer and they've not bought any other pharmacies, then they're probably going to have to make a fitness to practice application, and that in itself can take 3-4 months to approve. Sometimes it can take longer. We've had some experiences with first-time buyers where just their fitness to practice has taken 6 to 7 months, and then there's 3 months after that for change of ownership. But that is often the case with first-time buyers. My preference when advising clients on the type of process to proceed with, um, I would usually say to a first-time buyer that it would be sensible from a legal perspective to go for a share purchase. Yes, it requires more due diligence, and there can be risks, which that's where the accountants and lawyers help mitigate. But from an operational perspective, from a timing perspective, it's easier to just inherit the pharmacy that's fully operational, that already has the NHS contract in the right place, that already has the lease. Whereas with an asset sale, it works sometimes for more experienced operators where they know what contracts they'll need. They're able to have good rapport and show covenant strength with landlords, which Nick will get into later on in this presentation. But yeah, because asset sales can take quite a bit of time because of change of ownership, sometimes it makes sense for more experienced operators to do it because they're more known to the NHS, and the NHS actually has a habit of dealing with those applications faster because there's already fitness to practice approval, or the buyer potentially would have made another application for another pharmacy previously. So sometimes structuring also depends on the type of buyer that you have. And it's worth noting that with an asset sale, it can take potentially 6 months through the application. So that's just always worth checking in on at the start.
Okay,
So
brilliant.
I'm going to hand it back to you, Nick, just on the legal process now.
Okay, thanks, Matt. Okay, on the legal process, you can see from the screen that it's been split into three different areas: property, commercial, and lending. I'll start off with property, which applies to both an asset and a share sale. So the first thing that a seller solicitors would do would send across to the buyer solicitors the title documents, and that's the land registry title to show ownership of the property, whether it be a freehold or a leasehold. Um, and with those documents, whether it's a share sale or a asset sale, the buyer solicitors would put in hand what's called property searches, and these are searches that they carry out against with the local authority, which the drainage company, environmental search, and it's just all part of the due diligence process. They want to find out, for example, the local authority search would ascertain what planning permissions the property has had previously, or whether the road that abuts the pharmacy is adopted, or is it a private road. So those are things for the buyer's property searches. Commercial property standard inquiries will be applying on both a share sale and an asset sale. There are questions about the property, any disputes, insurance issues, what planning permission authorizes the use as a pharmacy. It's a questionnaire that you get that will be required by the buyer and the buyer's lender to be completed. And the documents that go with that are, for example, the EPC, the fire risk assessment and asbestos report, which are documents that the seller is required to provide to the buyer. The next set of documents is a draft lease or license to assign. On a share sale, you generally wouldn't need a license to assign. It would just be a lease if it was if the buyer or the buyer's lender required an extension to the term, and then you have ancillary documents which transfers the legal interest in the property to the buyer, and an authorized guaranteed agreement, which is generally required on a asset sale, where the landlord will require the outgoing tenant, i.e. the seller, to guarantee the obligations of the buyer coming in. And it can be released in the future when the buyer sells or when the term of the lease comes to an end, depending on the terms of the document. A due diligence questionnaire is raised by the buyer solicitors, asking all questions about the pharmacy and the business. Two different types of questionnaire, depending on whether it's a share sale or a business or an asset sale. The main agreement that captures all the terms or agreed between the seller and buyer is the shares purchase agreement for a share sale and the business purchase agreement for the asset. That will set out the purchase price, what warranties are to be provided, any restrictive covenants, the apportionments, and deal with the employees. The disclosure letter relates to the warranties that are going to be provided by the seller, either on a asset or a share sale, which Hammad will talk about later on. And you have ancillary documents, which are board minutes, 2P letters, resignation forms. In terms of lending, the buyer's valuation, the buyer's lending inquiries are on the buyer's side, but it's important so the seller is abreast of the situation, so he knows that obviously the valuation is stacked up and what inquiries that the buyer's lender will require to be answered in order for drawdown to take place. From if the seller has as a mortgage or a charge secured against the company or the pharmacy or the property, that will usually be required to be repaid on completion. So there is some engagement between the seller's solicitors and the seller's lender to make sure what needs to be paid, and obviously all the seller's obligations need to be discharged once that payment has been made. And drawdown is when the buyer's solicitor drawdowns the fund from their lenders to enable the purchase price to be paid over to the seller's solicitors.
Perfect. So we've talked through the structuring, the change of ownership application, and the legal process. In terms of the due diligence, most sellers would think that the due diligence process starts when there's a buyer that's been found and the buyer has sent that due diligence questionnaire. That is when the first formal request is made. But many sellers can prepare for the due diligence process now. They can prepare, months before the sale, years before the sale. So some of the important documents that sellers should have in order before a buyer is even engaged. I'll start with the legals, which is staff contracts. So many sellers don't have employment contracts. And the thinking is often that, well, when I took over the pharmacy, the staff didn't have contracts. And so I would imagine that if I'm selling it, the buyer shouldn't have to need the contracts either. I would say times have changed. So things were more relaxed from a regulatory perspective, from a bank due diligence perspective, from a buyer sophistication perspective. So now the way most buyers see it is that when the seller is marketing the pharmacy, they're also marketing it as being very clean, compliant, streamlined. And so when a lot of standard paperwork is not available, not around, it becomes a concern to buyers. So I would always say that have staff contracts prepared in advance. Many sellers are part of the MPA, so the MPA actually does have standard contracts. You can even ask your solicitors; they can prepare them for you. Knowing the current situation with your supplier contracts is also very important. So, for example, PMR contract, if it's uh, a new contract, if there's a fixed term, if it's just for maintenance, these things are important to know at the outset because it will form part of the buyer's inquiries. Insurance, I mean, it's a very common thing where sellers sometimes do forget to renew their insurance and they need to be reminded. But for the most part, this usually isn't a concern. It's just a case of making sure that you've got all your insurance policies ready. What we often find, whether we're acting for the sellers or the buyers, is that when we ask for insurance policies, sellers think that it's just the employment policy, employment liability certificate, and the PIPL, which is professional indemnity and public liability insurance. But there's actually also business insurance that comes along with it. All sellers have it. They just don't realize that it's a separate schedule. So just to say that all sellers also have business insurance, just find it and make sure that it's disclosed. And the last thing on the legal side is the compliance certificates. So Nikesh has mentioned fire risk assessments, asbestos surveys, EPCs, PAT testing certificates. These are standard compliance documents that banks, more than just buyers, banks care to see them because they tell the banks about the property's compliance from a health and safety perspective. If something goes wrong from a buyer's bank's perspective later down the line, then the security they enforce is against the property. So sometimes you would find for sellers, well, it's frustrating for sellers, but they find that buyers and their banks ask more about the properties than they might about the pharmacy. But that's usually because on the pharmacy side, from an accounts perspective, if the annual accounts are up to date, if the FP34s have the right company name and they're also up to date, and the seller is able to have some organized VAT returns and bank statements, then usually those are the key documents needed from a financial perspective. But again, I'm probably stepping on Atif's toes on that, so I will let him continue that conversation in his presentation. And then finally, buyers themselves often want to know working patterns, so staff rotas and group memberships. Sometimes that can be dealt with through solicitors. Sometimes that is just a conversation between buyer and the seller, which Hutchings are able to sort of facilitate. But it's important to know that buyers will be looking for this information as at a core level. So it's good to get this organized before a sale even starts. Oftentimes, sellers don't realize this, and then in the middle of the transaction, they've got to organize FRAs and asbestos certificates, which can then take weeks and months and add to the timescales to the transaction. So best to just be on top of it at the start. Another point to mention is on disclosures. So during the transaction process, the sellers have to give warranties to mention to explain that the pharmacy is free of litigation, free of employment issues, no NHS issues, no GPH issues, that payments incoming and outgoing have all been made on a timely basis, that there's no dispensing errors, things of that nature. If there are issues, then the solution is really just to tell the buyer. This is we're lawyers, but really honesty is the best policy. So and it's the best way to protect the sellers. If information documents are organized and clearly accurately disclosed to the buyer, then if the buyer completes without making a fuss about it, then that means after completion they can't raise that issue with those sellers again because it's been disclosed. So it's very important to just be as transparent and forthcoming as possible with all information, with all documents, even if it's something that might not seem necessary, like the GP surgery down the road is going to relocate, or there's going to be oftentimes nowadays buyers care more so about not just the pharmacy, but what's going around the pharmacy. So anything that sellers feel is material to share, it is usually worth sharing, and it just avoids a lot of headache later down the line. And then finally on 2P. So 2P is the Transfer of Undertakings Protection of Employment Regulations. It's the law that was passed to make sure that when a business is being sold, the buyer can't come in and sack all the staff. And essentially, it's to protect the employees on a business transfer. From a seller's perspective, what that means is that it's a seller's obligation to tell their staff that the sale is happening. So the question sometimes often we get is when is the best time to tell the staff? Should I tell them at the start of the transaction, which could take 3 to 6 months? Should I tell them in the middle of the transaction? What if they leave after I've told them? Or should I tell them at the end of the transaction, which if I'm a seller, I might feel confused morally because I might have been working with staff for 10, 15, 20 years and telling them on the day before selling that I'm retiring might be difficult for them to handle. So the answer is it has to be done before completion. Exactly how long before completion is dependent on the seller's own comfort. Um, I personally usually prefer that if the sellers haven't told their staff at the start, because sometimes sellers just tell their staff at the start and the staff sort of support the sale, help with the due diligence. But if that's not been the case, then usually it's when the seller has comfort that the buyer's got their bank valuation done up to date and that we're actually closing in on completion, maybe weeks away. That is usually for me a good time to start telling staff because it, they do need to know, and it also gives them time to ask any questions. But the short summary on the 2P process is that staff's details cannot change. The buyer would inherit staff as they are, so the seller can reassure that their staff that, and there'd be an assurance coming from the buyer in the form of a letter, 2P measures letter as it's called, that the buyer wouldn't be making any changes to the staff. So then the seller can then reassure their staff that that is actually the case. Um, I'm going to hand it back now to Nikesh to just go through some of the property aspects.
Thanks, Ahmad. The CPSC form we've already just discussed. It's a form that needs to be filled out that has sections about ownership, planning, environmental, insurance, what planning permissions you have, and EPC and fire risk assessment and asbestos reports. So that's a form that needs to be filled out as early as possible and as part of the due diligence process. Um, I want to move on to sort of negotiation points that often we find between buyer and seller. Let's start off with the lease. A rent deposit, usually depending on the buyer's strength of covenant, the landlord might ask for some security, and that's usually a rent deposit. It just ties up the buyer's cash flow, and it's usually a negotiation that the seller's involved in, but it's playing the middleman between the buyer and the landlord. Rent review, a buyer will always want to make sort of ensure that all rent reviews are up to date. So when they don't take over, they don't inherit those outstanding rent reviews. So there could be some dialogue that's been raised to whether those rent reviews have been concluded but just not documented, or they might have to be instigated. A buyer will always want to make sure that all the service charges paid up to date, what their repairing obligations are, and generally pharmacies are kept in good repair and condition, but a buyer's valuation report might identify things that need to be improved on. Guarantee provisions, a seller, especially on a share sale, will want to make sure that they are removed from the guarantee provisions of the company. That will obviously involve the involvement of the landlord and replace the seller with the buyer, especially on a share sale. Lender protection provisions are now, we find more common, that a buyer's lender will require certain clauses to be inserted into the lease to make sure that if the buyer defaults, the lender has the ability to step in and into the shoes of the tenant and make good any sort of defects of the lease. On a share sale and business sale agreement, you will find it common to both are restricted covenants where the buyer wants to restrict how the seller operates after completion, so he doesn't take any of the staff or compete with the business. There's also a warranty period, which is also often negotiation. Warranties are promises made by the seller to the buyer in relation to the business. The seller will obviously want to reduce the warranty period and have an increased amount of limitations before the buyer can raise a claim. Indemnities, the seller's point of view, they want to reduce the amount of indemnities that they give to a buyer. A buyer wants to have as many indemnities as possible because that will actually make any indemnity claim on a pound for pound basis usually, and that will make him whole. Completion accounts are obviously negotiated by the accountants, and they're usually prepared post completion. And the stock payment we've talked about generally on an asset sale, it's between 5 and 30 days. The seller wants to get their payment money paid, the stock payment as soon as possible. And on a share sale, that might be as part of the completion accounts. In terms of post completion, you'll either have a surrender, a release, or a transfer in terms of the property, and there'll be the pharmacy handover on the day of completion, so the buyer is able to run the pharmacy efficiently. On a share sale, obviously the bank mandates are in the name of the seller, so there'll often be a form that needs to be sent to the bank to say that the seller is resigning, and the buyer now has authority to operate the account. There'll obviously be the company resignations to be dealt by the accountants to document all the resignations and the required NHS and GPHC notices, and the completion accounts will be on a share sale that happens post completion. On an asset sale, from a seller's practical point of view, who'll close the supplier accounts, there'll be a post completion apportionment with the buyer in terms of any employee payments or any utility bills, and very rarely NHS payment, and obviously deal with the stock payment. Yeah, I'll just hand over to Hammad on
So,
use.
whilst we consider all the fantastic reasons to use Carter Bond, I'm also going to use this chance to try our poll. So I'm not sure if it's come up, but
Hi, Hammad. Yes, that the poll's
yeah,
running.
yeah, great. So one of the poll questions after this, we'll just give this a few more seconds, but one of the poll questions after this is Do I need to extend the lease now, or should I wait for the buyer to ask? And I'm wondering what the answer would have been at the start of this presentation versus the end of the presentation, because hopefully, by the end of the presentation, a lot of our sellers understand that it's probably best to get that lease extension started early on. Just give this one a few more seconds, and then I think there's one more poll. Are you okay to see this second poll question? Yeah, looks like it's up there.
That's that. Yep, that's running, Hammad.
It's good. So, whilst we let the audience answer some of the poll questions. So in terms of Carta Bond, we are recommended by the MPA. I believe we're one of the few firms that have that recognition. Between our various lawyers partners, we have probably much more than 30 years of experience, and we do act for both sellers and buyers. So the advantage of that is that knowing what the buyer is going to ask before a buyer's even been engaged often helps because it allows us to advise our sellers how they can preempt some of the questions, some of the issues that we often see, and then it ends up preventing those sort of last minute issues that crop up that really would be better if the sellers had just known what could have happened at the start. Um, so yeah, I'm just going to end this poll now and hand it over now to Atif for the accounting side of the webinar. Bear with me, Atif, as I
Lovely, thank
cancel
you,
my.
Hammad. That's great. Thank you so much, guys, for those informative presentations. Right, bear with me a second. We will just get our screen up. Lovely. So, hi everyone. My name is Atif. I'm the senior accountant at Hutchings Accountants, where we've been specialising in pharmacy sales and purchases in the UK for over 30 years. Today, we're talking about maximising the sale value of your pharmacy in London and the South East. We'll be looking at the 6 main steps of a pharmacy sale, some of the issues we see coming up along the way, and how you can best prepare for them. So we'll be covering reviewing your tax position, due diligence, the sale agreement, completion, the completion accounts, and paying your tax. Let's start with the first step, reviewing your tax position. If you're thinking of selling your pharmacy business in the future, it's never too early to start preparing, even if you don't plan to sell for a few years. Being properly prepared makes a huge difference, not only in the price you'll get, but also in what you'll be left with after paying the tax money. At Hutchings Accountants, we start by reviewing your accounts and tax position to recommend the most tax-efficient way to structure your sale. It's really important to look at this as early as possible, as optimizing your tax position can sometimes involve making changes to your business years in advance of an eventual sale. Getting this right has never been as important as it is now, with a number of risks, changes, and uncertainties facing the pharmacy market and beyond. Current events and political and economic instability around the world have changed our lives and contributed to rising costs in a number of areas. With inflation and interest rates still high, the UK economy is facing a challenge. We've also seen a change in the government recently, and the budget last year confirmed changes to the capital gains tax rates and business asset disposal relief, or BADR, which we'll talk about in more detail shortly. In summary, it was announced last year, see capital gains tax rates went up from 10 and 20% to 18 and 24%, and the rate for business asset disposal relief increased from 10 to 14% from the 6th of April 2025, and is set to increase to 18% from the 6th of April 2026. As you probably know, we had a budget announcement today, but as far as pharmacy sales and the tax on your sale go, there were no new announcements apart from the ones that had already been announced next year that would affect your tax position. There's also sector and market conditions to consider. Paul talked about the current state of the market, how it's been affected by recent events, but as we've seen, there's a number of factors can change things over the coming years. The best way for us to manage these risks is to be prepared. Once you've decided you want to sell your pharmacy, be sure to get specialist advice that takes your individual circumstances into account. This will help you work out the best way to structure your sale and make sure you qualify for business asset disposal relief where it's available. So let's take a closer look at sales structure and what the options are. We heard earlier about asset sales and share sales. So which is right for you? To decide on the correct structure for a company sale from a tax point of view, we calculate your estimated tax bill from each option, as there's a considerable difference in the tax treatment. If your pharmacy is run as a sole trade or partnership, the sale will be structured as an asset sale. If your pharmacy is trading through a limited company, the sale can be structured as either an asset sale or a share sale. So what are the tax implications of each? And is tax relief available? If your pharmacy is held personally and sold by asset sale, you'll be liable to capital gains tax and may be eligible for business asset disposal relief or BADR to reduce your tax bill. If, on the other hand, your pharmacy is held through a company, an asset sale would mean the company selling the pharmacy business and paying corporation tax on the gain. Business asset disposal relief would not be available, and you would potentially be subject to a further personal tax charge when you try to extract the profits from the company. A share sale only applies when your pharmacy is held through a limited company and means you'll be taxed personally on the gain and pay capital gains tax. In this case, you may be eligible for business asset disposal relief. So, what is business asset disposal relief? How does it work and what can it save you? Formerly known as entrepreneurs relief, it's a relief that can apply when someone sells part or all of their business and means you only need to pay tax at a rate of 14% on the gain as long as certain conditions are met. As announced in last year's budget, the BADR rate will increase from 14% to 18% from the 6th of April 2026. Each individual has a lifetime limit of £1 million worth of gains that can qualify. And how does it work? In a share sale, the qualifying conditions are you need to hold at least 5% of the shares and voting rights, be either an employee or officer of the company, and the company needs to be a trading company. These conditions have to be met for at least 24 months or 2 years before the disposal. And what can it save you? Without BADR, if you were to sell your business for £1 million, you'd be liable for capital gains tax at 24%, which would come to £240,000. But if you qualified for BADR, this would be reduced to 14%, meaning you'd only pay £140,000, which is still a huge tax saving. From April 2026, this would go up to £180,000. Now, there are some circumstances where you may not qualify for the relief, but they can usually be dealt with if you've got enough time and the right advice. When it comes to BADR, it's important to identify problems as early as possible so you can take the necessary steps to remedy them. If you're considering selling your pharmacy in the next few years, it's worth thinking about how you can increase the business value before you sell. And we recommend getting a professional valuation by pharmacy specialists and working with your accountant so you can identify key performance indicators affecting the value and look at how these can be improved over time. Your accountant can also review your tax position to see if there are any other issues that might increase your bill and work out how to resolve them. Looking at this ahead of time gives you the opportunity to plan and list out some prioritized targets you want the business to achieve and a timeline over when you want to achieve them. Now, as we've said, preparation is key, and it's worth looking at a bit more detail about some of the things we commonly see in pharmacy share sales that can cause problems or present opportunities. We talked earlier about the conditions for BADR. If you've got a company with more than one share class, this may need to be looked at as some of the shares might not qualify for the relief at present. Your company also might not qualify if it owns too many investments or holds too much cash. So it's worth looking at these things in advance to make sure you do qualify for the relief if you can. As we've said before, each individual has a lifetime limit of £1 million worth of gains that can qualify for the relief. So if you've ever incorporated or sold a business before, you might have used some of the relief already, in which case an excess of your sale proceeds over the unused relief would be taxed at the higher rate of 24%. Investment property owned by a company can cause problems with BADR also, but we also often see pharmacy companies that own the trading premises. Sometimes this might be included in the sale, or sometimes the seller might want to take them out before the sale and hold on to them. So advice needs to be taken to make sure that's structured properly to minimize the tax implications. As well as affecting BADR, the level of cash in the company can have other implications to your sale, which might need to be carefully considered. It's not unusual for pharmacy companies to have built up large reserves of cash. And it's such cases, it's usually possible to arrange for a cash extraction at completion, whereas the seller, you can take some of your cash out, which the buyer is not going to need to run the business. Another important area it's worth considering early on is what you want to take from the business in the form of salary, pensions, and dividends in the years leading up to the sale to make sure that you do it in a tax efficient way and you end up paying the lowest rate of tax overall on your lifetime earnings. So we've looked at some of the things to consider before a sale, but now let's talk very briefly about what happens once you've found a buyer. So the next step would be the due diligence process that Hammad and Nikesh talked about in some detail. As accountants, our job is to work with your solicitors to make sure this goes as smoothly as possible. As Hammad and Nikesh said, this will usually be more detailed in share sales because the buyer is taking on more risk. The buyers will usually want to go back over several years so they can be as comfortable as possible about the history of the company and what they're taking over. The next step is checking the sale agreement, which again is likely to be much more detailed in a share sale. Your lawyers will go through the sale agreement with the buyer's lawyers to agree a finalized version. And we'll also review this from a tax and accounting perspective, suggest any changes, and carefully go through the warranties to make sure the buyers are made of exceptional events or circumstances. You can see how important it is to engage lawyers and accountants who are specialized in pharmacy sales to get this bit right. When we review sale agreements, there are a number of things we look at. For example, the proposed method to calculate the net asset figure of the business, as this will affect your final payment. The agreement also sets out the terms by which the business must produce completion accounts, and that again is something we need to look at to make sure it's going to be in our interest. We'll also go through the tax warranties in the agreement very carefully and produce a list of any facts or circumstances that need to be disclosed. Putting the time in to get this exercise right means you can sign the sale agreement with peace of mind and confidence that your interests are protected. In a share sale, the total amount you receive for selling your shares is made up of the agreed price for goodwill and fixed assets of the business and an adjustment for the net asset position at the point of sale. The net asset position is made up of the company's current assets, which are things it owns or is owed, like cash, stock, money from the NHS or the VAT man, minus the liabilities, things it owes out, like money owed to suppliers, corporation tax to HMRC, anything else, bank loans, things of that nature. If there are more assets than liabilities, an additional payment is made for the net asset value. But if the liabilities are more than the assets, a deduction would need to be made from the goodwill payment. Now, when the buyers are happy with the results of the due diligence exercise and the sale agreement is close to being agreed, a target completion date is agreed for ownership of the pharmacy to transfer from you to the buyer. Once the target date has been agreed, we need to provide the buyer's side with an estimate for the net asset position at the planned completion date, which obviously we can't tell the future, so we need to estimate that as best we can. And that then gives the buyer an idea of what the cash position is likely to be and whether they're going to have enough money for their working capital needs. Now, it's generally better for completion to be done at the end of the month because that just tends to make all of the calculations and the cut-off period much more easy to calculate. After completion, we need to consider the completion accounts. These need to be prepared with extra care and attention to detail to make sure they're in line with the sale agreement and also represent the closing position as accurately as possible. So, as a seller, you can benefit from all the profits from your period of ownership without paying the expenses from after you've sold it. Once the accounts are agreed, the buyer will release the final balancing payment for the net current assets, which means you've now received full payment for your business. Right, now let's talk about the final step, paying the tax. The sale will fall in a tax year ending on the 5th of April and would need to be reported in your tax return for that tax year, which would then need to be submitted and the tax paid by the 31st of January the following year. So, as an example, if you were to sell your business on the 30th of November 2025, this would fall in the 2025-2026 tax year ending 4th of April 2026, and your tax return and payment would be due to HMRC by the 31st of January 2027. Now, if you were to have received a total of £1 million for your business and its assets, and you paid professional fees of £50,000, your total profit from the sale would be 950k. After deducting your annual allowance for capital gains, you're left with a taxable profit of £947,000. If you don't qualify for business asset disposal relief, this would be taxed at 24%, making a total of 227,280. With the current rate of BADR and a tax rate of 14%, this would come to £132,580. And if your sale was to complete after the 6th of April 2026 at the higher BADR rate of 18%, your tax bill would go to £170,460. So you can see how the timing of your sale can make a big difference to your tax bill and what you're left with in your pocket after paying it. Right, that's all from me. Thank you, everybody, for listening.
That's great, lovely. Thank you very much, Atif, Hammad, and Nikesh. Some really good explanations of quite a complex and difficult sort of topic of pharmacy sales there, and what's associated with it. So thank you for that. I think what for one of the sort of questions that sort of came up, one of the points you raised, Mad, was about it's one that sort of commonly raises when's the sort of best time to tell staff about a sale. So I think a really good explanation of that, and hopefully attendees will sort of take note. So that's great. So I'm just aware of the time. So sort of time is a little bit sort of short now for the evening. So however, we have had some sort of questions come in. So I'll just run through a few of those and let's sort of see how we go. But so just I think here for Hammad and Nikesh, one of the questions I've had come up is I've only got 4 years left on the lease. Should I look to extend it before I start the pharmacy sales process? Who'd like
Yeah,
to?
yeah, I'll take that one. Yeah, it probably is in the best interest to do that because no doubt that a buyer will, who's paying a substantial amount for the goodwill or the shares in the company, will want a longer lease, but his lender will also require usually 15 years left of the term. So I think it would be wise to start negotiations with the landlord to make sure that the landlord is willing to grant a lease extension to the term of the lease, because that would make your pharmacy more marketable.
Yep, yep. I'd certainly sort of concur with that. I think as we sort of touched on, sort of banks want that sort of longer sort of term lease, don't they? It makes the they sort of tend to tie the buyer's loan to the length of the remaining lease as well. So the longer the lease, hopefully that interprets into lower repayments for the buyer, and makes the whole sort of proposition more sort of affordable for them. So that makes sort of good sense. Another question that's sort of come up, sorry, can't bond as well. Should I repay all my business loans before selling my pharmacy?
Nick, I'll take this one. So it's a good question. So in most cases, it makes sense to pay the business loan as we're approaching completion. If it's obviously a very substantial business loan, then in most cases the purchase price would fund the repayment of that, so it might not even be possible. If it's a historic loan, so for example, seller took a loan, Barclays, NatWest, whichever the bank is, but in the 90s or early 2000s, and actually most of it has been repaid, and there's a small amount left, and there's still a charge on the property or the company. In that scenario, I would probably say that it would make sense to repay a small, like if the loan is a very substantially small loan, that I would make sense to pay that. But I would also do that closer to completion rather than at the start of the sale, just in case the sale didn't actually go through. The only reason I would say that the loan, again, it would only be ever be a very small loan that'd be worth repaying beforehand, before the buyer is actually completed, is to make sure that charges are removed before completion, because sometimes that in itself can cause a delay where a buyer or the buyer's bank would need a deed of release or evidence that a charge are going to be removed. It adds more undertaking and legal fees and lawyer time. So it depends sort of answer, but oftentimes if the amount is low and we have confidence in the buyer being ready to complete, then it's okay to start that repayment process, I would say a week or so before completion.
Okay, okay, that sounds sensible. Atif, do you have any sort of comment on that? Is that
I think that the only thing I would say, was a great answer, Ahmad, and I think that covers the main aspects of it. The only thing I would say, which Ahmad touched on, is if you have got a big loan, it's not unusual for it to be repaid at completion using part of the funds from the sale itself. So it's not a thing of, right, I want to sell my business, I've got a 200 grand loan, I need to get 200 grand first to repay that. It can come from the purchase price and be adjusted. I think the general kind of principle of the thing is that for banks or for buyers, no one really wants to port that loan across. So it is normally something that's got to be dealt with. But quite often, as I say, with bigger loans rather than the smaller legacy ones Amar's talking about, we do very often see them being paid at completion with the funds from the buyer. So rather than all the money going to you, some of it has to go to the bank, which isn't great, but it does mean that that loan is then discharged at the point of sale.
Mhm. I think just sort of to add on to that, I think one of the common things that we come across in pharmacy sale transactions is there can be quite an amount of cash that's sort of built up in the business as well, hasn't there, over the years? And maybe more so from buyers, sometimes they can look at that and see that as a quite a big hurdle to overcome. How do I deal with that? But again, that can be dealt with, can't it, during the sort of sale transaction?
Absolutely. In a way, it's almost like the opposite thing. One thing is where there's a deficit in the business, the other one, there's a cash excess. But the thing, I guess, is for a buyer, it becomes neutral. They don't need to get cash to pay for that cash. It can just be dealt with again at completion as part of the transaction, adjusted with the purchase price or, whatever mechanism the lawyers come up with between themselves. But the main thing is it's not a big worry. In fact, it's very usual, particularly with kind of family businesses people have had for many years and retirement sales. It's very usual to see sometimes some quite high cash amounts building up in the business. I
Mm.
think so. It's not an issue for a buyer, but there's probably one that you would want to take some tax advice on in terms of making sure you deal with that cash in the appropriate way, particularly if you are going for the business asset disposal relief, because it can cause problems there.
Yeah, yeah. And I think just to sort of add to that, I think it's important, as we've sort of stressed in, it's about taking, the right advice. Because these can be very sort of complex matters, and it's just making sure you allow sort of time to sort of understand all of this, and as I say, speaking to the right advisors who know how to advise the right way sort of forward for you, isn't it? I think really. Okay. A question that's coming from me. My pharmacy feels very tired and I'm considering a refit. but is it worth it if I'm planning to sell? Generally speaking, I wouldn't sort of say that it is worth sort of going down that refit sort of route. Again, obviously every circumstance is individual, and we recommend sort of having a more sort of detailed conversation around it. But generally speaking, I think there's a risk, obviously, building costs have increased significantly, refit costs, etc. You can potentially go down that route of doing a refit, go to the market, and it may potentially not work for buyers in the marketplace for particular reasons. You've obviously got that sort of financial sort of outlay, and there's no guarantee that you'll sort of reap the benefits of all of that sort of cost. I think maybe if you're there over the longer term, it's something to sort of consider. But certainly, I think short term, I think it's quite risky personally to go down that route of expensive refit, expecting to get all or more of your money back. I'd say probably not. But as I say, every circumstance is different, and we're more than happy to talk it through with anyone if they have queries around this. Give us a call, and a member of the team will speak to you about no issues. Right, okay. I'm just sort of conscious of the time. And appreciate the sort of questions that we haven't sort of asked. So we will be responding to any questions directly in the coming sort of days. But as I say, I just wanted to say thank you to everybody. The webinar this evening, as I say, that will be emailed to you directly, and also it will, as I say, go onto our websites as well. So you will get another sort of copy and another opportunity to hear what all the panel had to say. So, but thank you for attending this evening. It's very much appreciated. And I wish you a good evening, and it's goodbye from me.
Thanks, everybody.
Thanks,
Bye.
everyone. Thank you.
Thanks, everyone. Thanks, Atif. Thanks, Paul. Cheers.
you.
Thank you.
Thanks,
Bye-bye.
Paul. Thanks, Atif.